Okay, then based on the forecasted financial statement, we can derive the free cash flow to the firm. Actually, there are two concepts: free cash flow to the firm and free cash flow to the equity. Then first, I hope to discuss free cash flow to the firm. Then later I will discuss about the free cash flow to the equity. Okay. Then from the now I discuss about the free cash flow to the firm. Okay. I talk about the free cash flow to the firm. Free cash flow to the firm. Okay, then first I will explain the what is the meaning of the free cash flow to the firm. Then free cash flow to the firm, simple meaning of the free cash flow to the firm, I can say as the total cash flows. Then free cash flow to the firms, I can say as the total cash flows available for both equity and debt holders. Free cash flow to the firms. Free cash flow to the firms mean total cash flows available to distribute among both equity holders and debt holders. But free cash flow to the equity. Free cash flow to the equity means total cash flows available only for the equity shareholders. Okay. Then now I am talking about the free cash flow to the firms. That means the total cash flows available for both equity holders and the debt holders. Both equity and the debt holders. Okay, that's the thing that you need to keep in your mind. There are two concepts: free cash flow to the firm and free cash flow to the equity. Then free cash flow to the firms means the total cash flows available for both equity and the debt holders. But free cash flow to the equity means total cash flows available only for equity holders. Total cash flows available for only equity holders. That's the main thing that you need to keep in mind. Okay, difference between the free cash flow to the firm and the free cash flow to the equity. Now I am talking about the free cash flow to the firm. Then, as I told you, from the forecasted financial statement, we can derive the free cash flow to the firm. But issue is, how can we derive this free cash flow to the firm? This is about the cash flows. No, this is about the cash flows, cash inflow and cash outflow. Then how can we derive this net cash flows? We can start it from our P&L, profit and loss statement. Normally, from our forecasted P&L, forecasted profit and loss statement, we can derive our free cash flow to the firm. Then, when we consider about the when we analyze our profit and loss, it is included with non-cash expenses, non-cash income, all of those things it is included. Okay, therefore this net profit, then some can say this profit for the year we can get as our cash flow. Actually, can we consider this net profit as our cash flow? No, because we prepare this financial statement based on accrued basis. No, then accrued basis, not cash basis. Therefore, this can be included. These financial statements can be included with what? Non-cash expenses, non-cash income. Other thing is the accrued income, accrued expense. All of these things can be included in here. Therefore, this net profit we can't use as our cash flows. Okay, then what we need to do for that? Then from this net profit, we can derive the net cash flow to the firm. For that purpose, we need to do some adjustment to our net profit. Okay, actually, for the free cash flow calculation purpose, we use EBIT. EBIT means earning before interest and tax. I hope all of you have idea about the EBIT, earning before interest and tax. We normally use, although we start our free cash flow to the firm, this derivation process, we start from where? EBIT. We started from EBIT, earning before interest and tax. Simply, earning before interest and tax, we can say it is similar to our operating profit. Operating profit. Simply, this estimating free cash flow to the firm, we start from our operating profit or EBIT. Or theoretically, we call this as a NOPLAT. Net operating profit after tax. That means we need to incorporate tax impact into the EBITDA, then we can get the NOPLAT. Okay. Then that means EBITDA multiplied by 1 minus T. Then EBITDA multiplied by 1 minus T is equal to the NOPLAT, net operating profit after tax, or the operating profit multiplied by 1 minus T, we can say as our NOPLAT. Okay. Simply, this free cash flow derivation process, we need to start it from where? We need to start it from the NOPLAT. NOPLAT means EBIT multiplied by 1 minus T, or the operating profit multiplied by 1 minus T. What's the reason that we used EBIT, earning before interest and tax? Normally, this profit of the year, it is after deducting our finance cost or our interest expense. Okay. Issue is, when we discount our future cash flows, as I told you, we use discounting factor. No? This discounting factor is similar to our investor required return. Normally, we use our WACC, weighted average cost of capital. Then investor required capital mean, investors mean it is included with this. Investors means both equity and the debt shareholders. It is both. Then investors means both equity and debt shareholders. Therefore, only we can't use our equity shareholders required rate. Okay, we need to consider about our debt holders required rate also. Therefore, for the discounting factor, we use WACC. Then, if we use WACC for our discounting factor, if we use WACC as our discounting factor, automatically this finance cost adjusts into our valuation. Okay, therefore, for the free cash flow valuation purpose, we need to use what? We need to use EBIT, earning before interest and tax. Then we can multiply it by 1 minus T. Then we can call it as our NOPLAT. Okay, that's the reason we use EBIT. Okay, rather than not using the profit of the year, we use what? EBIT. From EBIT, we can start it. But then EBIT, we can't say as our free cash flow. As I told you, there can be what? There can be some non-cash expenses. Then if our EBIT or the NOPLAT, if it is included with non-cash expenses, we need to add back these non-cash expenses into the NOPLAT, like depreciation, amortization, provisions, gratuity provisions, or whatever. There can be different type of provisions. No, then these provisions we need to add back, because all of these are what? All of these are provisions. All of these are provisions, not cash expenses, or provisions, or the non-cash expenses. Depreciation, amortization, these are non-cash expenses. Then gratuity provisions, and there can be some provisions. These things, these are non-cash expenses. Therefore, what we need to do, we need to add back these non-cash expenses into our NOPLAT. Okay. Then, can we derive the, or is it same to the free cash flow to the firm? No. Then we need to identify pre-cash flows. Then for that purpose, we need to adjust during the year CapEx investment or capital investment into our NOPLAT. Simply, CapEx investment or the cash outflows driven from the capital investment, we need to deduct from our NOPLAT. Not only that, we need to adjust cash in or outflows due to what? Working capital movements. Because there can be some cash inflow or outflow that arising from the working capital movements. Working capital movement means increase in trade receivable, decrease in trade payable, or whatever. Movements from the trade receivable, trade payable, then accrued expenses, those things we need to adjust into our NOPLAT. Then we can derive, or we can calculate our free cash flow to the firm. Then simply, I can say, when free cash flow to the firm, I can derive it from EBIT multiplied by 1 minus T. EBIT multiplied by the 1 minus T. 1 minus T means tax. Then we can say this as our what? NOPLAT. Technical word, normally we use this as the NOPLAT, net operating profit after tax. Then NOPLAT. Then we can start this free cash flow to the firm from the NOPLAT. Then we need to add back what? Non-cash expenses. Then most common examples are depreciation expense and the amortization expense. Then we can add back these depreciation expenses and amortization expense into our NOPLAT or EBITDA multiplied by 1 minus T. And from EBITDA, again, we need to adjust what? During the working capital movements. During the working capital movements. Then during the working capital movements mean movements in where? Movements in trade receivable. Then movements in trade payable. Then movements in accrued expenses like this. There can be some working capital items now under non-current assets and non-current liabilities. Then those things we need to adjust into here other than the cash. Then, but cash we consider as our working capital, but for free cash flow to the firm calculation purpose, other than the cash or cash equivalents item, all working capital movements we need to adjust into here. Then I hope all of you have idea about the how can we identify the cash movements from our working capital. Then when we consider the asset side or the current assets, then simply we can say if our previous year, or we can say this year current assets or the let's assume trade receivable. For the trade receivable, if our this year trade receivable is less than the previous year trade receivable, we can consider it as a what? If this year trade receivable is less, let's assume this year trade receivable is 100, then last year trade receivable is 150. Then in this case, we consider this as a what? Our this year trade receivable is less than the previous year trade receivable. Therefore, we can consider this difference as our cash inflow. Cash inflow. Then for the current liability, other way, no? For the current liability, then let's assume our trade payable is this year 90. Last year, let's assume it as 100. That means this year one is less than the previous one. Then this 10 difference we identify it as a what? Cash outflow. Okay, I hope all of you have idea about the identification of this cash inflow and outflow from the working capital movements. Then actually, if you have idea about the cash flow preparation under the IFRS 7, so the LKS 7, or whatever, cash flow preparation under the financial accounting, definitely you know how identification of the cash inflow or outflows from the working capital movements. Okay, then these movements we need to adjust into here. And CapEx investment, we need to deduct, actually not plus, actually we can deduct CapEx investment from our EBIT. CapEx investment means capital investments. Because then from net profit, yes, from net profit, after add back the non-cash expenses and after adjust the working capital movement, then we can identify cash flows up to some extent available for the both equity and debt holders. But then for the going concern of our business, we need to invest in the capital assets, no? Then for that purpose, we need to incur some cash outflows. Then it is part of our business. Therefore, we need to deduct our CapEx investment from our EBITDA. Then we can derive what? Then we can derive the free cash flow to the firm. We can derive the free cash flow to the firm. Free cash flow to the firm. Okay, this is the process or the way that we can derive the we can derive the free cash flow to the firm. Okay, I hope all of you have clear with the process or the way that we can use to calculate the free cash flow to the firm. Definitely, you should keep in your mind because your examiner normally only give you the forecasted financial statement, forecasted balance sheet, and the forecasted P&L. Then based on the forecasted P&L and balance sheet, you have to derive the free cash flow to the firm for the forecasted period. Okay, therefore you should have this way or the method of calculating free cash flow to the firm. Then let's see, using my hypothetical scenario, then how can we calculate the free cash flow for this hypothetical scenario? For my hypothetical scenario. Okay, then this is for my ABC PLC. Then these details for my ABC PLC. Okay, for the ABC PLC forecasted period beginning from 2025 to 2030. Then I started from NOPLAT. Then how can we derive this NOPLAT? Then NOPLAT, I derived it As I told you, how can we derive the NOPLAT? NOPLAT, we can derive it from EBIT multiplied it by 1 minus T. EBIT multiplied it by 1 minus T. EBIT multiplied it by 1 minus T. Then EBIT mean earning before interest and tax. Here we have, there is our P&L. There is our P&L. Then for the financial year, financial 2025, we forecasted our net profit as how much? Net profit as our, we forecast it as 57. Then net profit, no, as I told you, we can't derive the free cash flows from net profit. We need to use what? EBIT, earning before interest and tax. Then how can we calculate the earning before interest and tax from the net profit? For that purpose, what we need to do? Then from net profit, then our net profit is how much? 57,000. Then we need to add earning before interest and tax. Then tax expense we need to add back. Then tax expense we need to add back how much? I mean, income tax expense 24,000 and interest expense. Okay, interest expense we need to add back how much? Interest expense, that means finance cost 59. Then we can derive our EBIT. EBIT as a 87,000. This is our EBIT. EBIT, earning before interest and tax. Earning before interest and tax. Then to derive the NOPLAT, what we need to do? We need to multiply this by 1 minus T. Then let's assume our tax rate as 30%. If we assume our tax rate as 30%, then how can we derive the NOPLAT or the EBIT multiplied by 1 minus T? 87,655 multiplied it by 1 minus 30%. 1 minus 30%. Then we can get what? We can get our NOPLAT or the EBIT minus 1 minus T. Then let's see. 1 minus 0.1 minus 0.3. No, I think 0.24. I don't know the value that I think I copy and paste from somewhere, but I don't know it is relevant for the previous one, whatever thing. Then simply for this P&L, I can get EBIT as how much? I can get EBIT as 66,000 EBIT multiplied it by 1 minus T, or otherwise I can say this as what? I can say this as the NOPLAT. I can say this as the NOPLAT. Then NOPLAT for the financial year 2025, I can get like this. Then like this for the other forecasted period, we can calculate. For the forecasted period, same thing we can calculate. Then for the 2026, our net profit is 67,000. Then our tax expense is how much? 29. Then we can add our interest expense of how much? Oh, we don't have interest expense for the next year, it's 0. Then we can get EBIT as how much? EBIT as 96,930. Then let's assume our corporate tax rate as 30%. Okay, 30%. If we consider this as a 30%, then we can get our NOPLAT as 67,151 for 2026 for the 2026. Okay, then like this for the other period we can calculate. Then our net profit we can get like this. Then tax we can add back. Then interest expense we can add back. Then we can calculate what? Then we can calculate the EBIT, earning before interest and tax. Then if we assume our corporate tax rate at 30%, then like this we can calculate our NOPLAT. Assuming our assumption is assuming corporate tax rate as 30%. Assuming corporate tax rate as the 30%. Assuming corporate tax rate as 30%, we derive our NOPLAT like this for our forecasted details. Okay, then how again How can we derive this? Net profit plus tax expense plus interest expense. Then we calculated what? EBIT, earning before interest and tax. Then from earning before interest and tax, we multiplied it by 1 minus 30%. Then from this we derive what? From this we derive no flat. Then we can start our free cash flow valuation from here. We can derive our free cash flow valuation from here. Then like this, we can start our free cash flow valuation from no flat. Okay, then if you have to perform the valuation, you should calculate free cash flow for the all given forecasted period. Then simply, then here we have forecasted detail from financial year 2025 to 2030. No, then for this 2005 from 2025 to 2030, you should calculate the NOPLAT. You should calculate the NOPLAT. Okay. Then based on the NOPLAT, then we can derive the free cash flow to the firm. That is the thing. That is our main purpose. What? Our main purpose is calculating this free cash flow to the firm. Then for that purpose, we need to start it from NOPLAT. Then now we know how way that we can use to calculate the NOPLAT. Net profit plus tax plus interest, then we can get EBITDA, then we can multiply EBITDA by 1 minus T, then we can get the NOPLAT. Then, as I told you, for this NOPLAT, we need to add back what? Our non-cash expenses or non-cash charges. We need to add back our non-cash expenses and non-cash charges. Then for the forecast period, then let's assume our depreciation and amortization expense like this. This is a hypothetical scenario. Okay, then let's assume our depreciation and amortization expense, amortization and depreciations, both rename as amortization, depreciations, amortization and depreciation. Let's assume like this. Then we need to add back this depreciation expense into our NOPLAT, and then we need to adjust our capex investment and working capital movement. Then for the net amount of capex investment and working capital, we can say it as the reinvestment. Okay, technically we call it as a reinvestment. Okay, reinvestment means total of working capital movement and the capex investment. Okay, technically we can say it as the reinvestment. Then we need to adjust reinvestment. That means our working capital movement and the capex investment. Then here I calculated all working capital movements for financial year 2025, 26, 27, 28, and 29 and 30. Then based on the movements, I adjust whatever the thing need to add back, things that we need to deduct, I deducted. Okay, I hope all of you have idea about the identify the working capital movement from cash flow perspective. Okay, I will do for one year. That means for the 2025, let's see identification of the working capital movement. Then what are the items that we need to identify as the working capital movement? It is completely based on the your business nature. Okay, then this business is manufacturing business. Therefore, under the current assets, what we have? Under the current assets, we have inventories, trade and other receivable, other financial assets, and the cash and cash equivalents. As I told you, when we identify the working capital movement, even cash and cash equivalent, we consider as a working capital from accounting perspective. But here, we don't consider this from the working capital. We don't need to consider it as a working capital. Okay. Then cash and cash equivalents or financial assets. Only thing is the inventories, trade and other receivable, trade and other payable, and the accrued expenses or accrued income. If we have some accrued income or prepaid income, like these things, we can consider as our working capital. Okay. Then for those items, we need to identify the working capital movement. Then let's assume for the inventories, then let's calculate working capital movement for the 2025. Then you can see in 2025 it is higher than the 2024. Therefore we can say it as a what? Since it is higher than the 2024, we can say it as the cash outflow. Main thing is for the current assets, you need to think it from inverse perspective. That means if it is higher than the previous year, we consider it as our cash outflow. If it is less than the previous year, we consider it as our cash inflow. Then for the trade and other receivable, you can see it is less than the previous year. No, since it is less than the previous year, we consider it as our what? Cash inflow. Cash inflow. Okay, like this for the current assets, we can identify the working capital movement. Okay, then if you examine some of the cases you examine can give total of the working capital movement. That means you don't need to calculate the like this working capital movement. But some of the cases, if you examine give forecasted balance sheet, then using forecasted balance sheet, you should calculate the working capital movements. Okay, you should calculate the working capital movements. Then like that situation, you need to use this method. Then please keep in your mind for the current assets. Then I can say for the current assets, if this year one is higher than, let's assume this year one is higher than the last year. If this year one is higher than the last year, like this, then for the inventories, you can see this year one is higher than the last year. We consider it as a what? Cash outflow. Then other way, if this year one is less than the last year, if this year one is less than the last year, we consider it as our cash inflow. Cash inflow. This is for what? This is for the current assets. Current assets. Okay. Then for the current liability, other way. For the current liability, then here we have trade and other payable. Then income tax. No, we don't have income tax. Then interest bearing borrowing. We can't consider interest bearing borrowing as our working capital, and bank overdraft. It is also not as our. It is not also our what? Working capital. Only trade and other payable here we can consider as our what? Working capital. Then we can say, we consider to last year, then this year we can identify the reduction, 20,000 deduction. Then for the current liability, main thing that you need to keep in your mind, if it for the current liabilities, we can say current liabilities, if this year one is higher than the last year one, we can consider it as our cash inflow. And if this year one is less than the last year, we can say it as our cash outflow. You need to keep in your mind. If your examiner will not give the net working capital movement, definitely you have to calculate. Okay, definitely you have to calculate. Then for that purpose, you should keep in your mind this way. How can we identify the working capital movement from cash flow perspective? Then for the current assets, if this year one is higher than the last year, we can say it as our cash outflow. Then if this year one is less than the last year, we can say it as our cash inflow. Then for the current liabilities, other way, if this year one is higher than the last year, we can see it as a cash inflow. Then for the other way, if our this year one is less than the last year, we can see it as our cash outflow. This is the way that you need to keep in your mind to identify the what? Working capital movement. Okay, then like using this method, I identified my working capital movement like this, and I adjusted this working capital movement into here. Then for the 2 into 5, it is a cash net cash outflow. Then actually we can verify this from here. Then this plus this, I think no. Yeah, I think I used another. Yeah, this is also the hard code data. Yeah, I think I got this from another working sheet. I think I manually calculate, manually fill the, okay, whatever thing. Then you need to calculate working capital movement like this. Okay, then like this you need to calculate working capital movement, and you need to adjust working capital movement into our no plan. That means based on the cash inflow and cash outflow, net amount you can adjust into here. And then capex investment. Here you need to deduct gross capex investment during the year. For the gross capital investment during the year, you need to deduct from our no plan. You need to deduct it from our no plan. Gross, okay, not net capex movement. Here you need to deduct gross capex movement. If you can take net capex investment, if you take the net capex investment, you don't need to add back depreciations. Okay, again you don't need to add back depreciation if you get net capex investment. But if you add back amortization and depreciation expenses, here you need to get gross capex investment. Okay, gross capex investment. Actually, based on the scenario, you can use whatever the method you can prefer. If you use net capex investment, that means if you adjust net capex investment to here, then again you don't need to add back the depreciation expense. Okay. And also then capex investment means including both tangible and intangible assets. Okay, including both tangible and intangible assets. Addition to the capex investment, here there are some additional reinvestment things that we can add by based on the business, different business categories. Then for the let's assume like that for the business, those who are engaged in more research and development activities, if this kind of business, if they have higher research and development expenses, then during the year that research and development expenses we can deduct from here. Okay, let's assume like pharmaceutical expenses, IT companies, like these companies, they have higher research and development expenses. Then these research and development expenses we can deduct from here as a reinvestment, as the reinvestment. Okay, actually it is based on the company or the industry, but for your examination normally you will not get like that complex scenario. Main thing is you have to adjust working capital movement and the capex investment. Then after adjust working capital movement, capital investment, and other non-cash charges into the NOPLAT, we can get what? We can get the free cash flow to the firm. Free cash flow to the firm. For the all forecasted period that your examiner gave financial statement, you should calculate free cash flow to the firm. Free cash flow to the firm. Simply for explicit for this time period, that means the time period that we can forecast the financial statement, simply we call technically this period as the explicit period. Then for the explicit period, for the all years, you need to calculate separately free cash flow to the firm like this. Okay, that means NOPLAT plus non-cash charges. The main examples are amortization and depreciation expenses. And we need to adjust reinvestment. Reinvestment means what? Working capital movement and the capex investment. Then we can get what? Free cash flow to the firms. Okay, I hope all of you got clear idea about the calculating free cash flow to the firms. Okay, using this hypothetical example, I hope all of you got the clear idea about the calculating free cash flow to the firm. And also there are some important things that you need to keep in your mind calculating the free cash flow to the firm. Since we have to calculate NOPLAT, we need to use tax rate. I hope you can remember. When I get the NOPLAT, I multiply EBITDA by 1 minus T. Then 1 minus T means our corporate tax rate. Here I assume my corporate tax rate as 30%. No? Here I assume my corporate tax rate as 30%. But practically, we need to consider about this tax rate. Then there are two concepts run for the tax: effective tax rate and the marginal tax rate. Then effective tax rate means the tax rate we calculated based on the accounting tax expense and their tax profit before tax. Simply, effective tax rate we can calculate tax expense divided by taxable income or profit before tax. Then simply for these financial statement for the historical period, that means for the financial year 2024, simply I can calculate effective tax rate, their income tax expense divided by their profit before tax. Then I can get their effective tax rate as 33%. Like this for the whole historical period, then I can calculate the effective tax rate. Okay, effective tax rate. But issue is when we use effective tax rate, some of the cases, then here also you can see for the financial year 2023, their effective tax rate is 219%, but it is abnormal. No, actually this 219, this higher amount, this is mainly driven from their deferred tax. It is mainly driven from the accounting deferred tax. Okay. Therefore, then using effect then the usage of effective tax rate is questionable for the some cases. Therefore, we can use the marginal tax rate. Marginal tax rate means simply that country tax rate. Simply that country corporate tax rate. Corporate tax rate. Simply we can use corporate tax rate for our calculation purpose. Here also, then I assume my corporate tax rate as 30%. Then it is a Sri Lankan corporate tax rate. It is Sri Lankan corporate tax rate. I use this 30% for my calculation purpose. Okay, and also practically we use our marginal tax rate if we have like this scenario. When we analyze our historical data, if we identify like this scenario, then if we think it is not suitable to use marginal tax rate, yeah, we can use our marginal tax rate. Actually, more safer way is use the marginal tax rate. But based on the scenario, then we can use the marginal tax rate or effective tax rate. Actually, it is a judgmental thing. Judgmental thing based on the scenario we can use. And also, firms with the large operating losses, then there can be some firms they reported larger operating losses for their historical period. Then if they have like this operating losses, then from tax law perspectives, we can claim these operating losses against our taxable profit. If like that situation, what is the option? Tax rate will be 0 for after tax operating income calculation and cost of debt deduction. Simply, our tax rate will be 0. For the operating losses available period, we need to consider our tax rate as 0 because we don't need to pay taxes. No, the main purpose is incorporate taxes into our EBITDA. We try to identify what free cash flow to the firm. Then if we have to pay taxes, it is also our cash outflow. No, therefore we deduct it from our EBITDA. But if there is operating losses, if there are operating losses that we incurred historical period, simply we don't need to pay taxes. Therefore, if that company have operating losses, we don't need to incorporate or we don't need to use tax rate for the periods that those tax losses available. That means our tax rate is 0. Then for that period, we don't need to use tax rate. We can see it as a 0. That's also you need to keep in your mind regarding the estimated free cash flow form. Actually, this is for the practical application, but for the some of the cases, your examiner, some of the cases your examiner, based on my analysis, I noticed that some of the possible your examiner didn't give the tax rate. But in that situation, you can use either marginal tax rate or otherwise you can use the country tax rate. It's okay, but you need to mention it as your assumptions. Okay, but marginal tax rate is also okay, but you need to analyze whether usage of the marginal tax rate is acceptable. Then, like that situation, you can see, then we can't identify exact marginal tax rate for our forecasted period because even if we take the average is also similar to, you can see here 50%. 50%. Okay, like that situation, usage of the marginal tax rate is not suitable. Therefore, like that situation, we can use the country applied corporate tax rate. Okay, and again, I need to mention it's a judgmental thing based on the scenario. It's judgmental thing, but you need to keep in mind this also for your examination purpose. Okay, this is about the estimating the free cash flows for our valuation purpose. Okay, this is the way that we can derive the free cash flows. Okay, I hope all of you are clear with this calculation of free cash flow. Okay, then we can move on to the another important topic. It is about the growth rate. For your examination purpose also, this is a most important topic as well as practically. We should have some idea about the growth rate. Then let's discuss about the growth rate.